All right, what's up, boys? This is gonna be the first video of a multi-video series. It should be around 10 videos total, where I'm gonna go over basically everything that I do on the charts, how I interpret the charts, how I look for entries, how I look for exits, how I know whether to buy or whether to sell, everything like that. This is video one, so we're gonna be going over the basics. Today we're gonna be talking about currency pairs, pips versus points, lot size, and how to calculate risk or profit. So, getting things started with currency pairs. A currency pairs a currency pair, sorry, is compared to like a stock. Just how there are several stocks, there are several different currency pairs. Are you gonna buy Tesla or are you gonna buy Amazon? Are you gonna sell Tesla or are you gonna sell Amazon? It's kind of the same thing. Are you gonna buy or are you gonna sell a currency pair? Everything here on the right hand side is a currency pair. So the way pairs work is you trade them, like it says, in pairs. So there's a base pair and a quoted pair. Every currency is 6 letters, right? The first 3 letters refers to the base currency, and the second 3 letters refers to the quoted currency. Now, what this means is that $1 Australian is the equivalent to 73 cents in American dollars. Now, it's pretty simple. One of the base pair is the equivalent to the chart price of the quoted pair. If you guys aren't too sure about what these letters stands for, here's a breakdown. AUD is the Australian dollar, Euro is the Euro, GBP is the British pound, CAD is the Canadian dollar, and JPY is the Japanese yen. So another example for base versus quoted pair. Euro USD. €1 is the equivalent to $1.19. So if I went to the bank right now and I give them a single euro bill, they would give me back exactly $1.19. Got it? It's pretty simple. It is nothing that really matters too much. It's just so you guys get an idea of how the price works. One of the base equals the quoted price of the quoted pair. Pretty simple. Again, you don't really need to know that. It's just like basic information. It doesn't change anything. It's just like knowledge. All right. So, what's a pip? A pip, every trader's goal is to catch pips, because pips is either how much you're going to make or how much you're going to lose. So the whole point of trading is to catch pips, right? Now, what is a pip? As you can see here, the current price is at 73900, right? Now, as you notice, there's 5 decimal places. The last decimal place, oh look, it keeps moving. Wait, actually, since it keeps moving, let's have a set price. Oh, I already have it right here. All right, look, let's say 0.73910. The last decimal place, meaning this 0, that is called a point. Now, a point is really small. That's why it's the 5th decimal. It's so small that it's kind of irrelevant. That's why the next best thing is called a pip, which is where the 1 is. So 10 points equals 1 pip. If this 0 went up to a 5, for example, you'd be up 5 points, or half a pip. If this 1 went up to 2, so if it was 0.73920, it would have gone up a full pip, or 10 points, right? Why are pips important? Like I said earlier, pips dictate how much money you're going to make or how much money you're going to lose on a given trade. How does it determine that? Along with your lot size. Your lot size is basically the size of your position. Comparing it to stocks, when you buy stocks, are you going to buy 1 share? Are you going to buy 10 shares? Or are you going to buy 100 shares? That's kind of what your lot size is like. Now, your lot size, before you place a trade, it's going to tell you what lot size do you want to open your trade at. So I trade at a 1.0 lot size. You guys are going to be trading at a slightly lower value. We'll talk about that a little bit later because it has to do with risk management and it has to do with the size of your account. But typically, most people trade at 0.5 or 1.0. What that means is that if you have a 1.0 lot size and your trade goes up 1 pip, you're going to be positive $10. Because when you select your lot size, your lot size times the number 10 is your dollar value per pip. So let's say you buy, right? You're up 3 pips on a 1.0 lot size. You make $10 a pip. Since you make $10 a pip, you're up 3 pips, you're up $30. Now, the opposite can be true. If you're negative 3 pips, you're going to be negative $30 when you use a 1.0 lot size. However, you can change your lot size before you change the trade. So, for example, let's say 1.0 is too risky. You don't want to open that. You want to do a 0.5. 0.5 times 10 is $5. So if you open up a 0.5 lot on any given trade, you are risking $5 per pip, right? This is pretty important because we usually risk about 15 to 30 pips a trade. So if you're using a 0.5 lot, you're risking $5 per pip. 5 times 30 pip loss, that's $150 per trade that you're risking. So depending on your account balance, you should have lower lot sizes. If you guys have a question about what lot size you should be using, check out the email that I sent you. I think I spoke about that. So, but just real quick, usually proper risk, I think you should use a 0.5 for every $1,000 in your account. So if your account has $1,000, you can trade with a 0.5 lot, which is $5 a pip. If your account is 500 or half of that, you can trade a 0.25, which is $2.50 a pip, and so on and so forth. Just keep doing the proportions. Now, I made an example here. Let's say we got into this entry at 0.73910 and the current price is 0.73970. If we bought at this price and it's currently at this price, we are positive 6 pips. So you're positive 6 pips. If you opened it on a 0.5 lot, you're going to be positive $30 because it's $5 a pip and you're up 6 pips. So $5 times 6, which is 6 pips, you're going to be up $30. If you're trading on a 1.0 lot size and you're up 6 pips, you're going to be up $60. Pretty self-explanatory. Now, how to calculate risk and profit. Exactly this math that we did here is what you guys need to get used to doing. So when you open a trade, I'm going to give you a stop loss and a take profit. The stop loss is usually 15 to 30 pips under the entry price, and the take profit is usually 45 to 80, maybe 100 pips above the entry price. So what this means is typically on any given trade, we are either going to be losing 15 to 30 pips or we are going to be winning 45 to 100 pips. So if you guys are trading, let's say you have a $200 account balance, right? I recommend that you trade a 0.1 lot size, which is the equivalent to $1 a pip. Now, $1 a pip, you're risking 30 pips, you're basically risking $30. Typical take profit anywhere between 45 to 100 pips. If you're trading on a $1 per pip value, you're going to be making $45 to $100. It's pretty simple math. If you guys have any questions about your lot sizes, then please hit me up. But that's pretty much it. It's super simple. Give me some feedback on this video. Am I talking too fast? Does my microphone sound muffled? Anything like that, let me know. And yeah, again, if you have any questions, feel free to hit me up. I'm going to put up here the abbreviations for the currency pairs so you guys get an idea of what they stand for. And yeah, we're not going to go over indexes and DXY today because that's a little bit more advanced. It's a little bit more complicated, but we'll get into it shortly. So yeah, I hope you guys enjoy the video. It's pretty basic, and just try to grasp your head around this concept. And yeah, I'll catch you guys next time. Thanks, boys.